For decades, the US dollar has been the undisputed champion of world currencies. But lately, it's facing some tough contenders.
The dollar was really the only candidate for this international currency status, and that status has persisted.
BRICS nations have been considering reducing their dependence on the US dollar, and China in particular has been flexing its economic muscles to boost the renminbi.
China wants more financial autonomy from the United States. It wants more resilience in the face of a future potential conflict.
As the US dollar's role in global markets diminishes, how should the US prepare for a world where the dollar is less influential? What steps can the United States government take to maintain the dollar's global reserve currency status? And what impact will China's effort to boost the renminbi have on the global currency landscape? This is Global Insights by Network 2020. Today, reshaping the world's wallet, the reality of de-dollarization. Today, we're speaking with Barry Eichengreen and Daniel McDowell. Professor Eichengreen is Distinguished Professor of Economics and Professor of Political Science at the University of California, Berkeley. And Dr. McDowell is a non-resident senior fellow at the Atlantic Council's Geoeconomics Center and an associate professor of political science at the Maxwell School of Citizenship and Public Affairs at Syracuse University. Moderating the discussion is Courtney Doggett, president of Network 2020.
So, to start, Dr. Eichengreen, turning to you, could you please provide us an overview of the historical dominance of the U.S. dollar and its significance in the global economy? Just a small question there. And could you also explain the difference between a primary international currency and a global reserve currency, just so we're using proper terminology?
Sure. So, an international currency is a currency like the dollar that is used for a variety of cross-border transactions to make payments connected with trade, to engage in cross-border lending and borrowing, for central banks and governments to hold as reserves that they can use when they want to provide dollars as lenders of last resort to their own banks and firms that may have borrowed abroad in dollars. So this function as a form of reserves is one aspect of the broader international currency characteristic of the US dollar. You asked me about the history in 1 minute. The dollar emerged as the dominant international currency really after World War II, for the same kind of reasons that English emerged as the dominant scientific language that people use when they talk to social scientists and other scientists from different countries, even though they may not be in the UK or the US at the time. After World War II, the United States was the largest economy in the world, engaged in the most foreign trade and foreign lending. No other country had deep and liquid financial markets open to the rest of the world. Other countries, including our friends in Western Europe, maintained controls on cross-border transactions and only began to deregulate their markets very gradually in the 1980s and 1990s. So the dollar was really the only candidate for this international currency status. And what is interesting is that it demonstrates the advantages of incumbency, that the dollar became the incumbent international currency, and that status has persisted despite a financial crisis in the United States in 2007, 2008, despite what some people might call the weaponization of the dollar, U.S. financial sanctions, and it continues to persist, to many people's surprise and to an extent, including my own. You mentioned my 2011 book, Exorbitant Privilege. And my forecast there was that the dollar would lose ground to competitors like the euro and the Chinese renminbi, the currencies of the two other largest economies, the euro area and China. But that loss of preeminence has proceeded more slowly than I predicted there.
Is there, just to follow up quickly, you mentioned a few factors that led to the rise of the dollar as that preeminent currency. Is there any one factor that you privilege over the others, whether it's the incumbency piece, the world's largest economy piece, some of the rules around regulations and the liquidity, to use a word that I'm starting to veer outside my lane? Are there any one of those that you think is of particular importance, or is it just that perfect storm of?
I think it's like a good stew. It has a number of ingredients. So the key ones here are size, stability, and liquidity. That has to be the currency of a large economy that is engaged in a lot of cross-border transactions. The currency has to have a reputation for holding its value, stability. And people have to be able to buy and sell it conveniently at low cost without moving markets against themselves. And that's what we mean by liquidity.
Thank you for that. Dan, turning to you, what are some of the recent trends that have led to the recent discussions that we're hearing about de-dollarization within the international context?
Thank you, Courtney, for the invitation. And I just want to start by saying it's really an honor to be on here with Professor Eichengreen, whose work has greatly influenced my own interest in this topic. So that's a real treat. So yeah, it's a great question. This term de-dollarization, if you're someone who doesn't pay a ton of attention to the role of international currencies, might have come out of nowhere in the last couple of years. And I think that's because the primary trigger for interest in this topic was the decision by the United States and its allies to rely heavily on financial sanctions as a tool to respond to the Russian invasion of Ukraine. Those sanctions included a range of different elements, including full blocking sanctions on large Russian banks, effectively blocking those banks from participating in cross-border payments and exchange. I think the most provocative element was the decision to sanction the Central Bank of Russia, which resulted in the freezing of around $300 billion of the country's foreign exchange reserves. I would note that those sorts of moves by the United States are not unprecedented. Similar blocking sanctions and even central bank sanctions have been used by the United States to target other countries before, but Russia really represents a different scale. It's the largest country to be sanctioned in this way. And of course, those sanctions were also rolled out at a moment where the entire world was watching what was happening in Eastern Europe. So I think the salience of the invasion kind of led to more attention to the issue. And then following on that announcement, right, you get a number of high-profile experts and observers that are suggesting, sort of in public debate, that this decision by the United States is going to be consequential, that it's going to provoke a fracturing of the world monetary system as Russia and other countries that are skeptical of U.S. power are going to seek alternative currencies to use in their international activities. And so I think the Russia sanctions are key. I would say they're not the only reason it's become part of the zeitgeist today. Briefly, I would also say, it fits within this now dominant narrative that the world economy is undergoing a transformation, this decoupling or de-risking between countries, especially those aligned with the United States and those aligned more with China. And so, if you think the world is in a period of decoupling in this way, in trade and investment, then why wouldn't we also expect a decoupling in the monetary sphere as well? And so I think that narrative is part of the reason this has become such a sort of a popular area of debate today.
Thank you. Dr. Eichengreen, could you outline some of the key advantages and challenges associated with the U.S. dollar's role as a strong currency? And, how have those characteristics evolved over time? And what implications does that hold for its future as a strong dollar in the global economic landscape?
Courtney, I'm assuming you mean the key advantages and disadvantages that accrue to the United States in
Correct. Yes. That accrued to the United States. Exactly.
So number one, convenience value. It's convenient, and for U.S. banks and firms to be able to do business with their cross-border, with their foreign counterparts in their own currency without having to go to a bank and ask for euros or yen or another foreign unit. In addition, it gives the United States a little bit of geopolitical leverage, as Dan was describing before. The dollar is then can be used to a limited extent as an instrument of U.S. foreign policy. There are those who argue that the demand abroad for dollars by foreign central banks, foreign governments, foreign commercial banks allows the U.S. Treasury to issue bonds at a slightly lower interest rate than otherwise, because there is this captive additional demand for those bonds abroad. People who've looked into this aspect conclude that the impact on 10-year U.S. Treasury bond yields is a small fraction of 1 percentage point, maybe 10 or 20 basis points. So this is not a big deal. Finally, the fact that dollars are so widely held and used by so many different agents around the world, and that markets in dollars are so liquid, make the dollar kind of a safe haven for not only U.S. investors, but foreign investors as well. So when a bad thing happens, there tends to be a rush into dollars, and our currency strengthens, our interest rates go down, or at least they don't go up as much as they might otherwise. Even when we in the U.S. are responsible for that bad thing, like the failure of Lehman Brothers in 2008, the dollar strengthened rather than weakened. It's interesting that since October 7th, we haven't seen those safe haven flows to the same extent. So again, U.S. 10-year U.S. Treasury yields have ticked up rather than ticking down, and the dollar hasn't moved much either way. So that kind of feeds into your earlier question and Dan's earlier question about whether things might be beginning to change.
Thank you. That you almost preempted a question I had, which was whether or not there's if people are prioritizing financial interests over political ones. If you've seen that in the past, but it sounds as though perhaps in the past, but maybe things might be changing. It's interesting. Thank you. Dan, just digging back a little bit into the sanctions question. You in your book, you talk about whether sanctions threaten the dollar status as the world's key currency. Could you just dig a little bit more into some of the main findings and insights that you found in that, if having written a whole book on it?
Sure. Yeah. I mean, I mentioned the Russia sanctions in 2022 in February of last year. That's, I think, the case that's captured the world's attention. But I think it's important to begin here with a brief discussion about the use of sanctions, financial sanctions by the United States, how that's increased quite dramatically over the last 2 decades. So the primary way that the United States initiates a new round of financial sanctions is through a presidential executive order, which of course is quite easy for the executive to issue. The executive order directs U.S. Treasury to add an additional group of entities. These can be individuals. These can be foreign firms. These can be foreign government institutions like the Central Bank of Russia. Directs Treasury to add that group of entities to effectively what is a blacklist that tells all banks operating in the United States that they cannot conduct business with any of the entities on that list. And so if you're on that blacklist, you find yourself unable to get a bank to process a payment for you, or in many cases, access your assets that might be held at that bank. So I mentioned the increasing use of the tool. In the year 2000, there were 22 of these executive orders in place that had a sort of a tranche of of entities to be added to that list. By the end of last year, so in 22 years, that had increased to 109 active executive orders. So that's like a five-fold increase in the use, just counting at the executive order level. If we actually looked at the number of targets, it's even in the 10,000s. We could also talk about country targets. In the year 2000, 4 foreign governments were directly targeted under a U.S. sanctions program. At the end of last year, that had increased to 22. Now, to be clear, not all countries are sanctioned at the same level. They're not all under Russia-style sanctions. But the critical point here is that more than 1 in 10 sovereign states in the world today is at least experiencing some degree of U.S. financial sanctions. So the basic argument of the book, briefly, is that the more the United States uses sanctions, the more it introduces political risk in the international currency system. What I mean by that is Washington is making its adversaries and foreign capitals more aware of their vulnerability that stems from dependence on the dollar, right? If I use the dollar and in turn U.S. banks for payments cross-border, if I use it for holding my assets in the dollar, right? Those assets using the dollar for payments are vulnerable to U.S. intervention, foreign policy intervention. So in the book, I document how awareness of that political risk has been rising in recent years, long before I would say the decision by Russia to invade Ukraine. In fact, the Russians were preparing for that sanctions event before it occurred. Some governments have responded by implementing what I call anti-dollar policies. They're measures that are designed to reduce their reliance on the dollar. And so not all those measures have not all those measures have succeeded. Many have failed. De-dollarization is not easy to accomplish. But basically, the book finds a number of things that if you're sanctioned, you're more likely to buy monetary gold on an annual basis than unsanctioned countries. Professor Eichengreen has some work on this as well. More likely to reduce U.S. Treasury holdings, less likely to use the dollar in trade, and more likely to have a bank join China's own new renminbi-based payment system. So broad patterns suggest that individual countries that are targeted by sanctions or at high risk of sanctions are likely to seek out alternatives. Again, not always able to achieve that, but that's something that we're seeing happening with greater frequency.
If I can follow up real quickly, as Dan said, my co-authors and I have looked at these issues empirically as well. I think, Dan, your comments are valuable, partly because they point out the difficulty of measuring precisely the incidence of sanctions, who is being sanctioned at what level, and that makes it hard to tease out the impacts. Insofar as we succeeded, we didn't find shifts from using the dollar or holding the dollar to using and holding other currencies, but we did find a noticeable tendency, as Dan said, for governments and central banks subject to sanctions to move away from currencies, including the dollar, toward gold. And that's an interesting illustration of the limits of the de-dollarization argument. If a central bank like Russia sells dollars and buys gold bars and then repatriates them, puts them on a boat, ships them home and vaults them in St. Petersburg and Moscow, that gold is insulated from sanctions, but can't be used for cross-border transactions, can't be used for financial transactions, can be used only with the very greatest difficulty to make payments in return for imports. So there is scope for de-dollarization, again, along some dimensions, but not others.
Thank you. And I was about to turn to you, Dr. Eichengreen, with a question about China. But before I do, actually, I'd love to just ask you, what does an alternative look like? Is there a system where, as we talked about, there could be a fracturing of the payment system? Is it, would it look like a world in which there's just, sort of equal parity given maybe to dollar and euro and then RMB? Or does one eventually, is there sort of an accumulative effect where there needs to be one main payments type system?
I think modern financial technology makes it easier to switch between use of different currencies. Used to be you had to walk down to your bank or make a phone call to your bank in order to buy and sell currencies, and then you had to wait a while, most of us, before the transaction was complete. Now we can all do this using our smartphones, all but instantaneously. So I think the older arguments that the convenience value of using dollars will continue to dominate and crowd out the use of other currencies grows weaker over time, just like Google Translate may undermine the dominance of English. People can write in other languages and I can still read it, courtesy of large language models and machine learning. Digital money will make it easier for the global monetary system to become more fractured, to use your language, but cross-border transactions to continue to take place.
Thank you. So maybe fractured is not quite the right word, and diversified maybe. So, thank you for that clarification.
Network 2020 is your gateway to a world of insightful discussions and impactful connections. Become a member today. As a member, you'll enjoy exclusive benefits like off-the-record discussions with leading global thinkers. Visit network2020.org to learn how you can join us in shaping the future of international understanding. Thank you.
Staying with you, Dr. Eichengreen, your book mentions the Chinese RMB as a currency that has attracted a portion of global reserves. Could you discuss the rise of the RMB as a reserve currency and its implications for the global financial landscape, and sort of what is the relative scale and direction of the trends that you are seeing?
We are seeing a growing share of cross-border transactions being invoiced. In other words, their prices quoted in and settled using the Chinese renminbi. I think Dan referred to this before, but that is mainly China's own trade with other countries. And if you try to reconstruct which central banks around the world hold reserves in the form of renminbi, Russia holds about a third of all identified renminbi foreign exchange reserves. So the renminbi remains kind of a niche currency, China's trade, Russia's reserves, because Chinese financial markets are still leagues behind US financial markets in terms of depth and liquidity. China maintains restrictive regulations, capital controls on getting money into and out of the country. If you look at interbank transactions between banks, SWIFT, the Society for Worldwide International Financial Telecommunications, where banks talk to one another and move money between their respective accounts. About 3% of all transactions through SWIFT are in renminbi. About 40 to 45% are in dollars.
Thank you. And Dan, I know you've worked a lot on China as well. I'd love to hear your thoughts on how China fits into the broader context of global currency dynamics and the potential competition it may pose to the US dollar.
Yeah, so I'll pick up right where Professor Eichengreen left off. I agree with everything that he just said. You know, my own view in terms of what China is after, what China wants. I think that's important because if you read a lot of the stories about renminbi today, it's often framed as, you know, China trying to topple dollar dominance, as if it's a contest between the two. I don't think that's actually what China's interested in. My own view is China wants more financial autonomy from the United States. It wants more resilience in the face of a future potential conflict with the United States, which I think China rightly recognized would almost certainly bring with it financial sanctions. China is paying very close attention to what's happening to Russia, and it sees the writing on the wall. I think you can see this in public discourse among financial elites. If you would go back 7-8 years ago, renminbi internationalization was predominantly an economic technocratic debate about the economic costs and benefits. Today, the strategic element is front and center. The Chinese recognize that RMB internationalization is critical, again, within reason. RMB internationalization within certain reason is critical to sort of Chinese resilience to U.S. coercive pressure. So, the dollar they recognize can be used against them, right? And historically, China's participation in the world economies relied heavily on dollars and the dollar-based payment system. So Chinese firms, Professor Eichinger was talking about this, generally price and accept payment for their exports in dollars, which means they're relying on American banks, essentially as correspondent accounts, the pipes through which these dollars flow. And those connections are vulnerable to U.S. foreign policy intervention. So very quickly, what's China doing? It is trying to build its own set of independent financial plumbing, if you will, right? A payment network. It's called CIPS. We're using lots of acronyms here, and this is really dry stuff, I guess. But it's short for the cross-border interbank payment system. This is China's own, again, a system of financial plumbing banks that are connected around the world. There's something like 1,400 banks in 111 countries that are connected to those pipes. It's been adding around 100 to 200 foreign banks a year. That's a pretty good clip. Now, I will say, not all those banks, we don't really know how many. In fact, I would say probably most of those banks aren't actively using the system, right? They're on the books. But use of CIPS is growing, according to PBOC, that's the Chinese Central Bank data. Daily transactions, according to the bank, have increased from the first quarter of 2020 to the fourth quarter of 2022, threefold. Okay, so that is sizable growth. It still remains a tiny fraction, like Professor Eichinger was saying, of the dollar system. But China has shifted from around 11% of its total trade being settled in its own currency to now around 30% today. So, bottom line, my view is this is about getting the plumbing in place for a potential sanctions event in the future to build in better resilience to that pressure, not about toppling dollar dominance. I don't think that's their goal.
Thank you. I'd like to try to get in a couple more questions before turning to the Q&A. And if you're listening and have a question and would like to put it in, you can, if you'd like to ask it, you can put it in the Q&A box. Turning to current events, Dr. Eichengreen, in light of the ongoing terrible conflict in the Middle East, there's a growing concern about whether Middle Eastern oil exporting countries, if dissatisfied with U.S. foreign policy, might consider shifting away from the use of the U.S. dollar. And you alluded to this earlier. So I'd be curious just to hear your thoughts on what potential implications this could have for the U.S. dollar's dominance.
So you'll recall that it was late last year, I think, that Chinese President Xi went to Saudi Arabia, and the country's respective leaders talked about maybe quoting the oil prices in another currency and not the dollar. I thought it was revealing at the time that they didn't offer to accept payment for, Saudi Arabia didn't offer to accept payment for its oil exports to China in the form of renminbi, all of which is to say that I think were OPEC or oil exporters more broadly begin to quote prices in a currency other than the dollar, that would have fewer implications than many people think. Dollar prices of oil go up and down with supply and demand. And if those prices were quoted in euros or renminbi instead, the prices would still go up and down day to day with supply and demand. So if there were an actual shift in the currencies that oil exporters accepted, I think that would be a more consequential change. And we haven't seen much evidence of that yet.
Thank you. And Dan, just one final question for you before I turn to the Q&A box. Could you just please provide some insights into how U.S. sanctions, particularly the ones that we've been talking about, imposed on Russia in response to events in Ukraine, have contributed to really strengthening the dollar, and offer some specific examples on how those sanctions influence the financial markets?
Well, this may not be directly attributable to sanctions, but it may be. I say that because I'm not sure myself. But if we look at recent data on the dollar's use, again, to go back to the use of the dollar as a payments currency. So, what are our counterparties using? Between third countries, not even involving the U.S. Which currency are they using to price and accept payment for goods or repayment of debt, et cetera? SWIFT data, this is the communication lines that banks use to talk to each other, records the currency that is requested, right, for payment cross-border. And interestingly, before the war, the dollar accounted for something like 40% of cross-border payments. I think Professor Eichengreen mentioned a number close to that before. Now it's around 48%. It's actually gone up since before the war. The euro has actually dropped quite a bit. Some of this, SWIFT says they've changed a little bit. I guess they're how they account for their data. So some of it could be statistical anomalies here or a new way of calculating the total. Probably not all of that. So it does seem like dollar dominance overall has increased in the payment space, right? That's separate from the reserve currency role. But at the micro level, so we can think about de-dollarization as this macro trend. I prefer to think of it as sort of country level, even country sector level phenomenon, right? Because I don't see the sanctions driven element of this as being something that's going to topple global dollar dominance, but you might see movement in certain areas among certain countries that are hit by sanctions. So I'll end with discussing Russia, where we have seen clear movement, and they frankly don't have a choice, right? Sanctions kind of push the Russian economy out of the dollar system. And so we know that today, around 20% of Russia's total trade, based on the most available data, which are from Russian policymakers who are saying these things publicly, so we have to trust them. Like 20% of Russia's trade now is settled in RMB. Around 70% of Russia's trade with China is settled in renminbi or rubles. Russians are saving more in yuan or RMB. Around 11% of total deposits are in that currency now. It's the most widely traded currency in the Russian foreign exchange market. And so these are just examples to show what sort of happens to a country that's kicked out of the dollar system. They're going to find alternatives. Those alternatives are not as convenient. They have significant drawbacks. But that's, I guess, at the micro level, what's happening. At the macro level, I don't think we see real evidence of declining dollar. In fact, if anything, we see the opposite.
Courtney, let me give you one more data point from earlier this year that I think is interesting. There were these extended discussions between Russia and India about not using the dollar in settlement of Russian oil exports to India. And those talks broke down because Russia wanted India to pay using Chinese renminbi, because Russia can use those renminbi to buy stuff from China. But India and China are not on good terms, and China wasn't in a position to make its ability to obtain oil from abroad contingent on being able to earn renminbi. So India offered rupees instead, and Russia said, no way. Those are not an adequate substitute for the dollar. We can't imagine that there's going to be a lot of stuff we're going to want to buy from you. So they're still using the dollar so far as we can tell.
Great example that there are these other bilateral relationships that are impacting things too. So thank you for that. Dr. Eichengreen, sticking with you, is there any chance of the BRIC countries developing their own currency as a bloc?
No. The BRIC countries are a heterogeneous group. We've seen how much difficulty over more than half a century the Europeans had in developing a single currency. They have their differences, but they are a more homogeneous grouping economically, financially, and politically than the BRICS.
With that, I want to say thank you both for a fascinating conversation. If you enjoyed these events, I hope that you will support Network 2020. We are a nonprofit and we rely on donations to keep these programs open. So thank you, Dr. Eichengreen, Daniel, really appreciate it. And thank you to everyone.
We can't thank you enough for being a part of this episode of Global Insights. To dive deeper into the world of insightful analysis and to learn more about how you can join our community, visit us at network2020.org.